Welcome to Life Theory, where we turn knowledge into power and help you build the life you've always dreamed of. Are you tired of working tirelessly for your money while it sits idly in a bank account? Are you ready for a revolutionary approach that flips the script and makes your money work for you instead? In our upcoming series, 10 Approaches to Make Your Money Work Harder for You, we will unveil secrets and strategies that the wealthy use to multiply their fortunes. Stay with us as we embark on this exciting journey of financial enlightenment and discover how to truly master the art of making your money work harder for you. It's time for a change. It's time for Life Theory. Number 1. Viewing money as a regenerating resource. In the grand narrative of financial success, one transformational idea stands out: the concept of money as a regenerating resource. It's a powerful shift in perspective that can unlock new levels of financial freedom and prosperity. Unlike finite resources that deplete with use, money can regenerate, multiply and grow if managed correctly. It's like a seed. Plant it, nurture it, and it can blossom into a tree that bears fruit year after year. Similarly, a dollar invested wisely today can yield returns in the future, effectively regenerating itself. This is the essence of capital growth: dividends, interest, and investment returns. This perspective is often what separates the wealthy from those struggling with their finances. The latter may view money as a scarce resource to be hoarded or spent immediately, resulting in a paycheck-to-paycheck lifestyle. The former, however, understand the regenerative nature of money and use this knowledge to build wealth over time. Moreover, seeing money as a regenerating resource encourages responsible financial habits. It prompts one to save, invest, and make strategic decisions that enhance the growth and multiplication of money, rather than squandering it on short-lived pleasures. The best part: anyone can adopt this perspective. It's not about how much money you have right now, it's about how you view and handle what you have. Whether your current financial situation is robust or precarious, viewing money as a regenerating resource can be the first step towards a more prosperous future. However, it's important to remember that this concept is not a get-rich-quick scheme. It requires patience, planning, and the discipline to make wise financial decisions consistently. But with time, the results can be truly transformative, turning money from a source of worry into a tool for building a life of abundance and financial security. Number 2. Transforming money into your servant. Sounds powerful, doesn't it? That's because it is. In our modern society, it's all too common for people to find themselves serving money. Chasing paychecks, working long hours, and sacrificing personal time and health just to keep up with bills and financial obligations. But is this the way it has to be? Not at all. Imagine for a moment a world where money works for you. A world where every dollar you own is like an employee, working tirelessly day and night to generate more wealth for you. This is the world of passive income and investments, the world where money becomes your servant. Passive income is the income you earn without actively working for it. It could come from rental properties, dividends from investments, royalties from a book you wrote years ago, or profits from a business that runs itself. The key here is that once the initial effort is put in, these income streams require little to no daily effort from you. Your money is working for you, even while you sleep. Investments, on the other hand, are like seeds you plant. You nurture them with time and patience, and they grow into trees that bear fruits year after year. Stocks, bonds, mutual funds, real estate, these are all potential investments where your money can work for you. The goal here is not to completely eliminate work. Work is an essential part of life that gives us purpose, fulfillment, and the resources to live. Instead, the goal is to create a balance where your active income is supplemented by passive income and returns from investments. When you achieve this balance, you'll find that you're no longer working for money. Instead, money is working for you. This is financial freedom, Life Theory fans. This is what it means to have money as your servant. Now, let's move on to the next part of our journey. Number 3. Delving into real estate investment trusts. What are REITs? Think of them as mutual funds for real estate. Just as a mutual fund pools money from multiple investors to invest in a variety of stocks or bonds, a REIT pools money to invest in a variety of real estate assets. These could include shopping centers, office buildings, apartments, warehouses, hospitals, hotels, and even data centers. Investing in REITs is a way to get into the real estate game without needing to buy, manage, or finance any properties yourself. It's a way to earn income from real estate without having to be a landlord. REITs are required by law to distribute at least 90% of their income to shareholders in the form of dividends, making them a great source of steady income. But the benefits don't stop there. REITs are also highly liquid because they are traded on major stock exchanges. This means you can buy and sell shares of a REIT just like you would shares of any other company. This is a huge advantage over traditional real estate investing, where your money can be tied up in a property for years or even decades. Another advantage of REITs is diversification. Because a REIT holds a variety of properties in its portfolio, it can provide exposure to the real estate market across different geographic locations and property types. This can help spread risk and potentially enhance returns. In essence, REITs give you the opportunity to profit from real estate investing without the hassle of property ownership. It's a fantastic tool to make your money work harder for you. Now, isn't that an intriguing thought? Number 4. Choosing the path of financial caution. In the realm of investments and wealth creation, caution doesn't mean fear. Instead, it signifies an understanding of risk and a willingness to manage it effectively. It's about taking calculated steps and making informed decisions. It is the idea that slow and steady wins the race, that it's better to grow your wealth consistently over time than to risk losing it all in a high-stakes gamble. One way of playing it safe is by investing in bonds. Bonds are essentially IOUs issued by governments or corporations that need to borrow money. When you buy a bond, you're lending your money to the issuer for a fixed period of time. In return, the issuer promises to pay you a fixed rate of interest and to return your principal when the bond matures. What makes bonds a safe bet? Unlike stocks, which can fluctuate wildly in value, bonds promise a fixed return. This can provide a steady stream of income and a sense of stability during turbulent times. Plus, if you hold a bond to maturity, you know exactly how much money you will get back. This predictability is a hallmark of the path of financial caution. Investing in bonds is just one of the many ways you can play it safe in the financial world. Other strategies might include diversifying your portfolio, investing in blue-chip stocks, or putting your money in a high-yield savings account. Remember, the goal isn't to avoid risk entirely. That's virtually impossible. Instead, the aim is to understand the risks you're taking and to manage them in a way that aligns with your financial goals and comfort level. Number 5. The concept of money parking. Great to have you back with us, Life Theory family. We're about to dive into a concept that might not sound too exciting at first, but trust us, it's an essential part of a savvy wealth management strategy, the concept of money parking. In financial terms, parking your money means placing it in an investment or account where it remains safe and easily accessible until you decide where to invest it for the long term. Think of it as a temporary holding area for your funds, a spot where your money can rest while you figure out the best strategy for growth. One popular option for money parking is a money market account. These accounts often offer higher interest rates than traditional savings accounts, and they provide easy access to your money when you need it. Plus, they are federally insured, which adds an extra layer of security. Another option could be short-term bonds. These securities offer low risk and modest returns, making them a good choice for preserving your capital while you determine your next investment move. You might also consider a high-yield savings account. While the interest rates on these accounts may not keep pace with inflation, they do offer a safe and liquid place to park your money. The point of parking money is not to generate impressive returns. Instead, it's about safeguarding your wealth while you decide on a more productive, long-term investment strategy. It's about having the patience and foresight to wait for the right opportunity instead of rushing into an investment that might not align with your financial goals. Number 6. The art of trading up. Trading up is a term you may associate with swapping collectibles or bartering goods, but it's also a powerful concept in the financial world. It's about starting with what you have, no matter how small, and gradually trading up to something bigger and better. It's a progressive journey, a step-by-step climb up the financial ladder. You might begin with a modest investment in a small startup. As the business grows and your shares increase in value, you sell your stake and use the proceeds to invest in something bigger. It could be a larger company, a real estate property, or a diversified portfolio of stocks. Or consider the real estate market. You might start with a small property, renovate it, sell it for a profit, and then use that profit to buy a larger property. The cycle repeats, and with each trade, your wealth grows. But remember, trading up isn't just about moving from smaller to bigger investments. It's also about moving from lower to higher quality assets. It might mean selling off risky stocks and using the proceeds to buy shares in a stable, blue-chip company. Or it might mean selling a volatile cryptocurrency and buying a more stable, income-generating asset. Trading up requires patience, knowledge, and a keen eye for opportunities. It's not a get-rich-quick scheme, but a methodical strategy for building wealth over time. Number 7. Exploring peer-to-peer lending. Peer-to-peer lending is a modern method for financing that removes the traditional banking system from the equation. It's a platform that connects individuals who need to borrow money with those who have money to lend. A key appeal is the ability to earn higher returns than traditional savings and investment options, albeit with a certain level of risk. If you put your money into a savings account or certificate of deposit, you might earn a small percentage of interest. But by lending that money directly to individuals or small businesses through a P2P platform, you can potentially earn a much higher return on your investment. Platforms like Prosper, Lending Club, and others have made this process straightforward and accessible. They handle the logistics, the risk assessments, and the repayment processes. As an investor, you simply choose who you want to lend to, based on the platform's risk ratings and the potential return. Remember, though, while the returns can be enticing, P2P lending is not without risks. Borrowers can default, and unlike a bank deposit, P2P loans aren't insured by the government. That's why it's important to diversify your investments within the platform, lending small amounts to multiple borrowers to spread the risk. Peer-to-peer lending is a testament to the innovative ways technology continues to reshape the financial landscape, providing new opportunities for making your money work harder. It's yet another tool you can add to your wealth-building arsenal. Consider whether P2P lending might fit into your investment strategy. As always, it's crucial to do your research and understand the risks involved. Number 8. Going against the financial current. It's easy to get caught up in the hype when everyone is investing in a certain stock or buying up properties in a trendy neighborhood. But the most successful investors often don't follow the herd. Instead, they see opportunities where others don't, and they're not afraid to venture into uncharted waters. Take Warren Buffett, one of the world's most successful investors. His philosophy is simple: be fearful when others are greedy, and greedy when others are fearful. This contrarian approach has paid off tremendously for him. When the dot-com bubble burst at the turn of the millennium, Buffett, who had largely avoided investing in the highly priced tech stocks, emerged unscathed while many others lost fortunes. Or consider real estate. When the market is hot, prices are high, competition is fierce, and it can be hard to find a good deal. But during a downturn, when others are scared to invest, you can find bargains. Buying low in a down market can lead to significant profits when the market eventually recovers. This isn't to say you should always go against the grain, rather, It's about not being swayed by the crowd and making decisions based on careful analysis rather than fear or greed. It requires patience, courage, and a strong belief in your own judgment. The goal isn't to be different for the sake of being different, but to make smart, informed decisions that align with your financial goals. And sometimes, that might mean swimming against the tide. Number 9. Placing bets on appreciating assets. Appreciating assets are investments that increase in value over time, offering you the opportunity to grow your wealth passively. These assets can come in various forms, such as real estate, stocks, and collectibles, among others. The key is to identify which assets have the potential for growth and then strategically invest in them. For instance, real estate has long been considered a solid investment option, as property values generally appreciate over the long term. Savvy investors look for up-and-coming neighborhoods or properties in need of renovation that can be purchased at a lower cost and later sold for a profit. Another example is investing in the stock market. By purchasing shares in well-established companies or promising startups, you can potentially benefit from the growth of these businesses over time. This strategy typically requires research, patience, and a well-diversified portfolio to mitigate risks. Collectibles, such as art, rare coins, or vintage cars, are another type of appreciating asset. While these investments can be more volatile and require a keen eye for detail, they offer the potential for significant returns for those who can spot valuable items before they become widely recognized. When investing in appreciating assets, it's essential to have a long-term perspective and avoid the temptation to sell when the market experiences temporary fluctuations. Remember, the goal is to ride the wave of appreciation over time and allow your wealth to grow organically. Number 10. Backing potentially fruitful ideas. In the world we live in today, ideas are the new currency. With the proliferation of technology and the democratization of information, the opportunities for innovation are limitless. It's no longer about who has the most physical resources, but who has the most revolutionary ideas. Venture capitalists, angel investors, and even everyday individuals through crowdfunding platforms are pouring money into innovative ideas with high growth potential. From cutting-edge tech startups to social impact projects, the ideas that people are willing to back are as diverse as they are transformative. Now, you might be wondering, how do you identify a potentially fruitful idea? It requires a blend of market understanding, intuition, and courage. You need to assess the demand for the product or service, the viability of the business model, and the strength of the team behind the idea. But more than anything else, it requires you to believe in the idea and the change it can bring about. Remember, every successful company we see today, from Apple to Amazon, was once just an idea. Someone had to see its potential and take a chance on it. And while not every idea you back will become a runaway success, the ones that do have the potential to yield extraordinary returns. Investing in potentially fruitful ideas is not just about financial gain. It's about being part of the process of innovation and change. It's about helping to shape the future. This is an exciting, dynamic form of investment that embodies the life theory spirit, pushing boundaries, questioning the status quo, and never stopping in the quest for success. We've journeyed through the landscapes of understanding money as a regenerating resource, making it our servant, and backing ideas with potential. Thank you for joining us on this journey. We're excited to see where these strategies take you in your quest for financial success. Until next time, continue to challenge your boundaries, question the status quo, and never stop rising. Stay tuned for more empowering content from Life Theory. Keep on rising.